To start this off, I want to quote Joe from over at Nanalyze. Social media is the worst thing that has ever happened to retail investors.
Or something close to it.
I'm paraphrasing, maybe. Sorry, Joe. But I think we get the point across. We completely agree with you.
And just to pin a name to this, we're talking about Supermicro Computer today. A few years ago, when we covered it in 2023 and 2024, we were critical of SMCI. We passed on it. And, well, the stock price tanked the second half of 2024 and never really meaningfully came back since then. There were a lot of comments, many of them which have since been deleted. There's a lot of social engineering that happens out there on social media, YouTube included, other social accounts where people can upload their research anonymously, and then other anonymous accounts comment on it. And you don't know who these people are, what their agenda is, and there's no accountability.
And that's a real problem. So let's go ahead and take a look at what's going on with Supermicro, because we're seeing some signs that this stock is going to get pumped here again. And so what is fundamentally going on with the business? This is a no hype, no nonsense look at Supermicro Computer after their most recent earnings. And if you think back to just a couple of months ago, back in June, they proposed this $7 billion equity and equity-linked financing transactions to fund AI orders. What does all that mean, Nick?
Yeah, they initiated an at-the-market ATM, the really ironically acronymed ATM program, which they said they're not going to utilize anymore, at least not currently, as well as issued preferred stock. We'll come back to that in a moment, and took out some more debt in recent months as well to fund the purchase of semiconductors and components needed to build those servers and fulfill orders to hyperscalers, data center operators, enterprise companies, you name it.
And you're going to see a number of charts from fiscal.ai today. That's the sponsor of today's video. We disclose all of our sponsors and relationships. Fiscal.ai/CSI gets you 15% off any paid plan. You can make charts like these right here that you're going to see in the video and analyze businesses like we do here at Shipstock Investor, digging down deep into the financials. Fiscal updates their data right after earnings reports within the hour, so you can get right on it and see what's moving the stock. Make sure you check it out, fiscal.ai/CSI.
So item number one to call out, Supermicro's gross profit margin currently and for the next quarter guidance is supposedly at a trough, but it's at less than 11%. The guidance is at the midpoint, 10.6, 10.8 gross profit margin. The gross margin is double, triple, or even more at some of its comparable peers. Dell, HPE, Lenovo, Vertiv. Now, the business models are a bit different. That accounts for some of it. But this is an important point to keep in mind as we walk through some of the other items that pertain to you, a potential shareholder, and what that means for your ability to profit from owning a business like Supermicro.
And you may look at this chart right here with total revenues for Supermicro, and you're thinking, wow, their revenues are growing significantly. But one of the issues that Nick just mentioned is that blue bar, the operating profit, not moving commensurate with that revenue that they're bringing in. And there's a few reasons for this. We'll talk about that in just a moment. But looking at their free cash flow as well, you can see that they have spent most of the time free cash flow negative because they have to spend so much money on those parts that they're supplying their customers and not getting that back in return. And so it's been pretty rough on shareholders. Of course, this last quarter, they've made a little bit of headway again, free cash flow per share up as well. But over the long haul, this has been an issue.
And here's but one reason why. So this is from SMCI's balance sheet, accounts payable and accounts receivable over time. What is that? Well, accounts payable is money spent on semiconductors, GPUs, CPUs, networking, other various components. Those companies generally need to get paid. No money, no chips. Accounts receivable is the bill that Supermicro sends to its customers. And so why has this metric historically been elevated?
Well, one of the ways that Supermicro tries to compete with its peers like HPE, Dell, Lenovo, is they have much more generous payment terms for some of their customers. Maybe they drag it out for longer. And just to call out, that's one of the reasons why their operating margin is a lot lower, is because they're competing significantly on price.
Yeah, and this has become something of a source of contention again as of late, but a lot of companies that provide infrastructure and equipment have in-house financing departments. It's basically a way that they can get a higher margin for the product that they sell and make sure that they actually get paid in a timely fashion. That's something that Supermicro lacks. Again, this ultimately boils down to differences in business model, but that's an important thing for you to consider as a shareholder. This hasn't structurally changed yet for Supermicro, and that's going to be a headwind for the company's ability to sustainably generate positive free cash flow and grow free cash flow over the next few years, even as revenue goes through the roof because of the big boom in infrastructure and AI data center build out.
And just one final call out, one final chart from Fiscal, the balance sheet for Supermicro. In green, you see total cash had a huge bump in this most recent quarter to 7.5 billion. That's from some extra debt and sale of stock. In yellow and in blue, you see their debt. And then in pink, 4.2 billion is preferred stock. Tell us a little bit more about what that is.
Yeah, that's part of the equity linked cash raise that they announced back in June. And that preferred stock, which trades under the symbol SMCIP for preferred, actually pays a 7% dividend. It's still an equity. It's going to be volatile and fluctuate. It's not a bond. It's not a fixed income security, but you get the higher dividend payment. If you're looking at Supermicro Computer, you're not limited to just SMCI stock. That's not to say you should go out and buy SMCIP instead. But if you are looking at SMCI, this is another reason why the company is going to struggle to create value for you as a shareholder, because that preferred stock gets paid first. The debt holders get paid first via interest bearing and dividend claims on the company's cash flows. And that preferred stock, again at 7%, is going to be a significant destination for any cash flow that Supermicro is able to generate.
Thanks everybody for watching. I think the last thing I have to say is stay safe out there, know what you own and why, think about who's influencing your decisions, and we hope this was helpful in your analysis of Supermicro Computer. Make sure you hit the subscribe button, hit that notification bell, or you'll probably never see us again. Thanks a lot, YouTube.
It's funny because it's true.
Funny because it's true. Not funny, actually. Check out chipstockinvestor.com, and we'll see you again soon right here.